Greeting of the day. Welcome to the second session of Principles of Accounting. This is Muhammad Shakir Ibrahimi. We'll discuss about what is uh, different terminologies. In the last session, we studied about the accounting and then functions of accounting, parties interested for accounting informations, and we discuss about the bookkeeping, a bookkeeping entry system that we had. So this is what we discussed in the last session. In today's sessions, we'll discuss about the accounting terminology. The first thing is, what is business? The first term is you are using business. So business is nothing, any activities which is taken for any legal activity which is taken for the purpose of profit. That is what is called business. Simple definitions that we can select. So if you are buying or selling of goods for the purpose of what? Earning profit, money, right? So that is what business is. The second one is proprietor. Proprietor is a person who invests money or things to the business, like the owner proprietors. Proprietors are nothing but the person who start business, who invest their own money for running of the business. That is called proprietors. Transaction, which the dealing happening between two or more than two persons, that is what it is called dealing. So a simple transaction, any dealing which is between two or more than two person happening is called transactions. Second is vouchers. Voucher is any written evidence which is given for the business transaction is called voucher. So when any document, any legal document which is we are giving for the business transaction, that is called vouchers. In voucher we have two types. One is invoice, second one is memo. Invoice is given by the seller to the buyer for the credit sales, where memo is given by the buyer to the seller for that sales. So that is what it's called. We have invoice. Invoice is nothing. It is a part of types of voucher which is giving or a document which is given by the seller to the buyer. The next terminology is account. Account. What is account? Account is nothing. It is a systematic device of recording the transactions. So whether increasing or decreasing in anything, so that is called what? Account. The second one is liabilities. Liabilities, any legal, financial debt or obligation which arise for the business operation purpose or for the running of our business, that is called what? Liability. In the liability we have two types. One of them is called short-term liability, second one is called long-term liability. Short-term liabilities are those liability which is for the less than 1 year, where long-term liabilities are those liability which is for more than 1 year. So up to 1 year, that is called short-term, or more than 1 year, it is called long-term liability. The next one is purchase. Purchase is nothing, the cost of payment or the payment that you are paying for the purchasing of some goods or services, that is called what? Purchase. And purchase we have two types. One is cash purchase, second one is credit purchase. Cash purchase or those purchase which is paid through cash base, so the dealing is happening through cash, nothing else. Where credit purchases, the dealing is on a credit base, they will pay in money in the future. That is what it's called, credit purchase. And so same sense we have the sales. Sales is nothing but the amount of earn from goods or service is called sales. So sales again two types. If your dealing is happening through cash, that is called cash sales. If your dealing is through credit, it means that they will pay you in the future. That is what credit sales we have. The next one is revenue. Revenue, all sort of income that you are receiving is called revenue. That whatever money are earning, which is including profit and your expenses, that is what it's called, or your cost, that is called revenue. So any money that you are receiving is called revenue. Next one is expenses. Expenses nothing, the payment which is made for the certain objective or for the activation of that objective is called expenses. Profit, when my revenue is more than income, or when my revenue is more than expenses, that is called profit. When my revenue is less than my expenses, that is called losses. So the income, the amount that you are receiving, that should be more than your expenses, that is what profit you have. Capital. Capital, the cash or the other asset that you are contributing to the business is called capital, like giving cash, building, land, machinery, merchandise. So all of them are part of capital. Now discount. What is discount? Discount is a deduction in the value of goods or service called discount. In discount we have two types of discount: trade discount and cash discount. Trade discount is normally using for the purpose of promotions, for the marketing purpose, where cash discount is giving for the purpose of receiving cash on time. Because like we are using trade discount, like in the market, if you see they are announcing discount, that is called trade discount, because they are deducting and they will give you at net price that things, and that used for the promotion purpose, for attractions of customers, where cash discount is used for the to protect from bad debt. Bad debt means that it is they will not pay you in the future, so they will give you discount to pay that money as soon as possible to the organization. The next one is discount allowed and discount received. Discount received is the person who received the discount, that is called discount receiver, and the person who gives discount, that is called discount allowed. Commission, any charge which is paying for the purpose of performing task, is called commission. Next one is we have stock or inventory. The maintaining of goods or merchandise at store is called what? Stock. The next turnover. What do you mean by turnover? Turnover is nothing but the amount of total sales in a particular period of time that you have, that is called stock turnover or inventory turnover or sales turnover that you have. Account receivable and account payable. Account receivable is called debtors, which means that when we say account receivable, that is what part of credit sales is there. So when we say that we have credit sales, we are using account receivable. Account receivable is nothing but a person to whom goods are selling on credit, that is called what? Account receivable. Like I am selling a bottle of water, so I am account receivable from Ahmad, because he's purchasing. I am the seller, he is the purchaser. When he is the purchaser, he is account payable, because a person who purchases goods on credit, that is what is called account payable. And then we have note payable and note receivable. Note payable is an instrument which is given by the firm, any written is an instrument which is given by the firm for the on certain future date payment, that is called note payable or bills payable. Where note receivable is any written documents that is given by the person that they will pay you money back, so that is what note receivable, that is given by the firm to the person that we receive this much amount, that's called note receivable or bills receivable. Next one we have bad debt. Bad debt is nothing, the uncollected money or the written off of uncollected money is called bad debt. Bad debt means that the person is not paying you money at all in the future, the credit dealing, the liabilities that you have, so that is called bad debt. The doubtful debt is the estimate of amount of debtors that which expected to become bad debt during the coming period was called doubtful debt. Doubtful debt is nothing, the amount of credit that you sell to someone on credit, and you have a doubt, a problem that whether he will pay you or no in the future, so that is what doubtful debt that we have. The amount which we are saving for the recovering of the bad debt losses, that is called reserve for the bad debt. So reserve for bad debt is nothing, it is the amount that we are saving with ourselves, and the future if there is bad debt occurs, so we'll try to use that for the recovering of their losses that should not be affect our businesses. Next one is outstanding expenses. Outstanding expenses nothing, those expenses which is occurred but not yet paid. Suppose you're working somewhere in the organizations and the organization are not paying to you, so that is the outstanding expenses for the organization. Prepaid expenses is that expenses which has not been earned but you receive money in advance, right? So you paid money in advance, sorry, so means that you are paying money in advance, but you will use it in the future, like insurance we are paying in the beginning of the period, so we'll use by the passing of time that insurance, that is what prepaid expenses. Accrued income are those income which earn but not receive, right? Opposite of outstanding expenses. We have worked somewhere but we didn't receive money, so that is income, that is earned for us, right? Income. So well, that you work somewhere and you did not receive, that is called accrued income. The next one is earned income. Earned income or those income which you receive money in advance, but it not done your duties, you not provide your services, you not, but not earned in the specific year, specific month. That is called earned income. That is part of adjustment into that we have. Asset. What is assets? Asset is nothing. Anything which is valuable for the organization, and it have three rights: ownership, right of ownership, right of usage, right of sales. So that is called what asset. Suppose I have a mobile phone, I have the owner, I am the owner of it, right? I can sell it, I can use it. So that is what asset. Some people says that we are going to go to restaurant and we are eating food, so we are using it, we are the owner of that food because we paying money, and but we cannot sell it. So that is not asset. Asset is those things like your fan, that you are using fan, you're the owner of it, you can sell it. You should have these three specifications. So according to this, we have two kinds of asset: current asset and fixed asset. Current assets are those assets which is quickly convertible into cash within a year. So suppose we have less period of time for the converting that into cash, that is called current asset. That is less than a year, like cash, bank account, the raw material we are using for the selling purpose, and suppose we have other inventory stocks that we have, right? Receivables that we have. So these all of them are current assets. Fixed assets are those assets which is not quickly convertible into cash. One definition. Second definition: current assets are those assets which is convertible into cash more than 1 year. Fixed assets, sorry. The third definition: fixed assets are those assets which is our business is running based on that. Our business operations are running based on that. That is called fixed asset. Again, in the part of fixed asset, we have two types of asset. One is tangible asset. Second one is intangible asset. Tangible assets are those assets which can be seen, which can be touchable, like building, like furniture, like we have machinery. These different things. Where intangible assets are those assets which cannot be seen or which cannot be touchable. That is called intangible asset, like intellectual property rights, business license that we have, like trademark that we have, and different other examples we have for the intangible asset that we have. Then we are coming to the equities. Equity is nothing. The right possessed by the owner or outside against the asset of the firm is called equities. Equity is normally the amount you are investing into the business. That is called what? Equities that we have. So this simple, we have equities. Equity is nothing, but it is the amount of investing that you possess by yourself as the owner to the company. And then we have normally equities here divided in two categories: owner equity and liabilities. We discuss what is liability and owner equities. That the same definition I given you. Owner equity is the amount of your own amount giving as an investment perspective. That is equities. Next one, drawing. Drawing is nothing. The amount or the cash or commodities that you are withdrawing from the business for the personal use. That is called what? Drawing. Right? Draw. Withdraw ham we can use it, and drawing we are also using it. Right? So that is what we have. Next one, financial statement. In the last slide, financial statement is the financial report which prepared by the accountant for the showing of business result, business operation result. So that is giving after a particular period. In the financial statement, we have three types: income statement, balance sheet, and cash flow statement. And financial statement, in the income statement, it shows the profit and losses of the company. So this income statement is preparing first because we have to show our revenue, and then after expenses, and then you will get gross profit. After paying tax, interest, depreciation, amortization, you will get the net profit. So it shows the net profit or loss of the company. Balance sheet shows the financial position of a company. How it says that we can show the financial position of a company. So here, if we see, we have in the balance sheet two sides. One is asset side, second one is liability side. In the asset side, balance sheet is whatever we have in our own organization. In the Liability side is that amount of liability and the amount of shareholder funds are visible to us. So in that case, so we are comparing what is that we have in a business, what is the shareholder investment, and then we can calculate different ratios, different things to analyze whether our financial position of a company is good after a specific period or no. The next one is accounting cycle. Accounting cycle is nothing but it is the record of the business transactions when occurs. It is the next. It is the record in the various statements. So we are recording this financial statement in different steps. So the very first you have journal in accounting cycle, and ledger, and trial balance, adjustment entry, worksheet, financial statement, closing entry, and post closing trial balance. So when transaction is occur, so we have to know these different things, and then we can prepare it accordingly. So that is what the accounting step, accounting cycle, as we said in the definitions, that accounting is a process of identifying and recording. So identifying and recording is happening in the journal, and then we said classifying is in the part of ledger, and then we said that summarizing and analyzing is happening in the part of summarizing in the part of trial balance, and the rest is happening analyzing part and interpreting and communicating. So if we are preparing this financial statement, which I say that three types we have: income statement, balance sheet, and cash flow statement. So we'll share this to the public. So that is what things which we have in our organization, and we are preparing, right? So this is what we have. So I hope you have learned